Total rewards represents the sum of all resources available to an employer that may be used to attract, motivate, and retain employees. In the context of the exams, compensation is categorized into two primary buckets, direct and indirect. Together, these form the total rewards package, used to attract, motivate, and retain employees. Direct compensation. Direct compensation refers to the liquid financial rewards paid to an employee in exchange for their labor. Base pay. This is the fixed amount of money an employee receives regularly, hourly, wages paid for the actual time worked. These employees are typically non-exempt under the FLSA and must receive overtime pay. Salary. A fixed annual amount paid, regardless of hours worked, usually for exempt professional or managerial roles. Variable pay, incentives. This is pay at risk, meaning it is earned only when specific performance goals are met. Individual incentives. Commissions. Often used in sales, a percentage of the revenue generated. Merit pay. A permanent increase in base pay, based on performance reviews. Piece rate, compensation based on every unit produced, for example, $2 per garment sewn. Group/organizational incentives, gain sharing, rewards based on group productivity improvements or cost savings. Profit sharing, employees receive a share of the company's total profits. Stock options. The right to purchase company shares at a fixed price, aligning employee interests with shareholders. Indirect compensation. Indirect compensation, benefits, includes non-cash value provided to employees. While not paid directly in a paycheck, these represent a significant cost to the employer. Legally mandated benefits. In the United States, employers are required by law to provide Social Security and Medicare, federal insurance programs. Unemployment insurance provides income for workers who lose their jobs through no fault of their own. Workers' compensation. Coverage for medical expenses and lost wages due to work-related injuries, FMLA, unpaid. While unpaid, the job protection provided is considered part of the indirect reward structure for companies with 50+ employees. Voluntary benefits. These are offered, at the employer's discretion, to stay competitive. Health and welfare, medical, dental, vision, and life insurance. Retirement plans, 401k or 403b plans, often with employer matching. Paid time off, PTO, vacation days, sick leave, and holistic well-being days, perks, tuition reimbursement, gym memberships and employee assistance programs, EAPs. Equity and executive compensation. For the senior level exams specifically, you must understand high-level compensation structures. Deferred compensation, pay that is earned now, but paid out at a later date, for example, pensions or 401k. Golden patterns, golden handcuffs, large payments triggered by a change in ownership or incentives designed to keep key executives from leaving. Stock options are a form of equity compensation, used to align the interests of employees with those of shareholders. They provide employees the right, but not the obligation, to purchase a specific number of shares of company stock at a fixed price within a certain time frame. To understand how stock options function, you must master these four terms: grant price or strike price. The fixed price per share at which the employee can purchase the stock. This is usually the market value of the stock on the day the option is granted. Vesting period. The period of time an employee must work for the company before they earn the right to exercise their options, exercise. The act of the employee, actually purchasing the shares, at the grant price, expiration date. The date by which the options must be exercised, or they become worthless, usually 10 years from the grant date. Types of stock options. The IRS distinguishes between two main types of stock options, each with different tax implications for the employee and the employer. Statutory, incentive stock options, ISOs, target, usually reserved for key employees and executives. Tax advantage, employees do not pay taxes when the option is granted or exercised. Taxes are only paid when the stock is sold. If held for a specific period, the profit is taxed at the lower capital gains rate, rather than ordinary income. Restrictions, ISOs must follow strict IRS rules. For example, a $100,000 limit on the value of shares, that can vest in a year. Non-statutory stock options, NQSOs, target, can be granted to employees at all levels as well as consultants and directors. Tax treatment, when the employee exercises the option, the spread, the difference between the grant price and the current market value, is taxed as ordinary income immediately. Employer benefit, the employer gets a tax deduction equal to the amount of ordinary income the employee recognizes. Other forms of equity compensation. While options are common, the exam curriculum also covers other equity-based rewards. Restricted stock units, RSUs, a promise to give the employee shares of stock, or the cash equivalent, at a future date. Once vesting requirements are met. Unlike options, RSUs always have value, as long as the stock price is above zero. Employee Stock Purchase Plan, ESPP, a program that allows employees to use after-tax payroll deductions to buy company stock. Often at a discount, up to 15% off the market price. Phantom stock, a bonus plan that mimics stock ownership. The employee doesn't actually own shares, but receives a cash payment, equal to the appreciation of a set number of shares over time. Incentive pay, also called variable pay, is categorized by the level of performance being measured. Each type is designed to drive specific behaviors, from individual productivity to organization-wide collaboration. Individual incentives. These are designed to reward the effort and output of a single employee. They are most effective when a job has a clear line of sight, meaning the employee can see how their specific actions directly lead to the reward. Piece rate systems. Employees are paid a fixed rate for each unit produced. Straight piece rate, a set price per unit. Differential piece rate, a higher rate is paid for units produced above a standard threshold, for example, Taylor or Merrick systems. Commissions, primarily used in sales. The incentive is a percentage of the total sales volume, or revenue generated. Merit pay, a permanent increase in base salary, based on past performance. While common, its drawback is that it becomes a fixed cost for the employer, regardless of future performance. Behavior-based incentives. Rewards for non-production behaviors such as perfect attendance, safety records, or completing a professional certification. Group incentives, gain sharing. Group incentives encourage cooperation and teamwork. The most common form is gain sharing, where the organization shares the financial gains of productivity or cost savings with the employees. Scandler plan, traceable plan, on labor costs. It uses a ratio of labor costs to the sales value of production, SVOP. If the ratio improves, costs go down relative to production. The gains are shared. It heavily relies on employee suggestion committees. A Carter plan uses a more complex value-added formula. It calculates the difference between the sales price of the product and the cost of the materials used to make it. Impro share, improved productivity through sharing, a strictly mathematical approach that compares standard hours to produce a specific volume against the actual hours taken. If the team finishes faster than the standard, they share the savings. Special incentives. These are unique incentive structures, often reserved for specific groups, like executives, or specific organizational goals. Organizational-wide incentives. Profit sharing distributes a portion of the company's total profits to all employees. This promotes a big-picture mindset, but often lacks a strong line of sight for lower-level employees. ESOPs, employee stock ownership plans, a qualified retirement plan, where the company contributes stock or cash to buy stock into a trust for employees. Executive incentives, stock options, the right to buy company stock at a strike price. If the stock value goes up, the executive profits. Phantom stock, a promise to pay a bonus equal to the value of a certain number of shares without actually granting ownership of the stock. Claw